Okay, I want you to close your eyes for a second, just for a moment. Visualize this with me. You're sitting at, I don't know, a heavy mahogany desk. And in front of you is a stack of paper. And when I say a stack, I mean a tower. It's 10,000 earnings reports high. That is, what, millions of pages of dense corporate legal speak, all printed in like 8-point font?
The kind of stuff that's intentionally designed to just make your eyes glaze over after the first paragraph.
Exactly. It's designed to be unreadable. Now, imagine your job is to read every single page of that tower, but you can't just read it. You have to cross-reference every single number in there with real-time sentiment from, say, 50 million social media posts. Then you need to pull up satellite imagery of retail parking lots to verify foot traffic counts. And at the same time, you're analyzing the shipping logs of every major port from Shanghai to Rotterdam. And you need to do all of that, spot a pattern, form a thesis, and execute a trade in the next 3 seconds.
It sounds like a nightmare. For a human, that's physically impossible. It's not just hard, it's a joke.
Right. But for the technology we are digging into today, that isn't a nightmare. It's just Tuesday.
It is just Tuesday, a regular old Tuesday.
Welcome to the deep dive. Today is Tuesday, February 10th, 2026. And if you've been, casually checking your 401k or maybe buying a few tech stocks here and there, you might not have noticed that the ground beneath the entire market has completely shifted. We aren't just talking about future tech or some speculative bubble anymore. We're talking about a fundamental structural shift in how capital moves around the world.
We really are. For the longest time, I mean, for decades, really AI in trading was this black box. It's sort of a mythical tool that only the Rentechs, the Citadels, and the quant geniuses on Wall Street had access to. If you didn't have $1 billion under management and a server farm in New Jersey, you were basically fighting with sticks and stones while they had laser-guided missiles.
But here we are in 2026, and the missiles are on sale at the corner store.
That's a slightly terrifying way to put it, but yes, that box has been cracked wide open.
We've got a massive stack of research to get through today. We're going to look at white papers on what they're calling autonomous finance, specs on these new agentic squads that retail traders are building right from their home offices. And we have to talk about the regulatory upheaval that just killed the pattern day trader rule. It's a huge deal. But to really set the stakes, I want to start with a study from Stanford that I found. Oh, it's absolutely mind-blowing.
The AI analyst study, this is the one that really woke people up, I think.
It did. So they created an AI analyst, essentially just a bot, and gave it nothing but public information. No insider tips, no secret back channels, no whispers from a CEO on the golf course, just public data, SEC filings, news reports, earnings calls, the stuff anyone can get. And they ran a 30-year simulation.
And this is the part that, let's just say it upsets the entire multi-trillion-dollar mutual fund industry. The AI didn't just survive. It outperformed 93% of professional human mutual fund managers.
93%. That is just a staggering statistic. And we're not talking about by a small margin, right?
No, not by a percent or two. It wasn't a rounding error. It outperformed them by an average of 600%.
600%. That number it's absurd. It feels wrong to even say out loud. It implies that the entire industry of active management, the guys in expensive suits sitting in skyscrapers analyzing stocks, is essentially obsolete. But I have to play devil's advocate here for a second. Is the AI just lucky? Or is it doing something that humans literally cannot do?
It's not luck. It's what we call information arbitrage. See, humans, we're narrative creatures. We read a story about a company, we like the CEO's charisma, we see a cool new product, and we form a bias, an emotional attachment. The AI is stripping all of that away. It's processing the entirety of the data that is technically public, but practically invisible to a human because of the sheer volume. The edge isn't knowing someone on the board anymore. The edge is synthesis, pure, unbiased synthesis at scale.
So that's our mission today. We are going to demystify this black box. We're going to explore how AI actually reads the market in 2026, the specific tools that are sitting on retail traders' desks right now, not just at hedge funds, and the massive regulatory changes that have completely reshaped the playing field.
It is a revolution. We're calling it autonomous finance. And it's no longer just about picking a stock. It's about agentic squads and intelligent execution. It's a whole new vocabulary for a whole new world.
Agentic squads. I love that term. It sounds like something out of a sci-fi movie, but it's happening right now. We're going to unpack that in a bit because the idea that you have a squad of bots working for you is just fascinating. But let's start with the landscape, the big picture. Why does AI matter so much now in 2026? What is driving this shift?
I think it comes down to the convergence of two main factors, the explosion of granular data and the psychological limitations of human beings. Let's talk about the data first. You mentioned the parking lots in the intro. That's what we call alternative data.
Right. And it used to be that hedge funds would literally hire private planes to fly over Walmart parking lots to count the cars. That was top secret alpha generating intel 10 years ago.
Exactly. And today, that data is completely commoditized. Any retail trader can get access to it. But in 2026, it has gone way, way deeper. We are now looking at real-time transactional data. We're talking about aggregated, anonymized credit and debit card swipes from millions of consumers.
So wait, before a company like, say, Chipotle even announces their quarterly earnings, the AI models effectively already know what the revenue number is going to be.
Precisely. They're not guessing. The models have seen the transaction volume in real time for the entire quarter. The earnings call is just a formality for them, a confirmation. And it's not just swiping cards, it's geospatial data. We are analyzing thermal imaging of factories from satellite.
Thermal imaging, like you're looking to see if the factory is hot.
Yes, exactly that. It sounds crude, but it's incredibly powerful. If the roof of a manufacturing plant in Shenzhen is hot, it means the machines are running. Production is humming. If it's cold, production is down. The AI then correlates that temperature data with shipping logs from the nearest port and credit card swipes from their biggest retail partners. It can predict a supply chain problem weeks, sometimes months, before a CEO is forced to admit it on a conference call.
So the AI is playing detective on a global scale, connecting these seemingly random dots.
It's watching the factory temperature in China, the credit card swipes in New York, and what we call the digital exhaust, things like app usage, web traffic, user churn all simultaneously. It's ingesting price feeds, on-chain analytics for crypto, macro indicators like CPI reports, and high-frequency order book signals. A human brain just jest. It simply cannot synthesize that amount of diverse information in real time. It's not built for it.
It's the difference between trying to read a library book by book versus digitizing the entire library and searching it instantly with a single command.
That's a great analogy. It's a perfect analogy. And then you have a second piece of the puzzle, the psychological aspect. We've known for years, for decades, that the biggest enemy of the retail trader isn't the market, it's themselves.
Fear and greed, the two old classics.
It's deeper than just those words, though. It's biological. It's the cortisol spike you get when a trade goes red. Your amygdala, your lizard brain, it hijacks your prefrontal cortex, your rational decision-making center. You enter fight or flight. In trading, fight looks like revenge trading.
Revenge trading is the one that always gets me. It's so destructive. You lose $500 on a stupid trade and suddenly you aren't analyzing the market anymore. You're just gambling. You're trying to get back to zero. You double down on a risky position because you're angry at the market.
Exactly. And flight looks like selling a winning position way too early because you're terrified the profit is going to vanish. You can't stand the anxiety. The statistics are brutal. Something like 70% to 80% of retail traders lose money over time, and the primary driver is this emotional instability.
So how does AI fix our broken biology?
Well, AI is the ultimate emotional firewall. It doesn't have an amygdala, it doesn't have cortisol, it doesn't get greedy, and it doesn't get scared. It doesn't care if you need to pay your rent next week. It executes a predefined strategy based purely on logic and data. In 2026, the trader who uses AI is effectively outsourcing their discipline to a machine that has perfect discipline.
It's moving from gut feel to data-driven in the most literal sense possible. And the infrastructure that's supporting all of this is massive now. I was reading about this AI factory movement where corporations are doubling, even tripling their AI spending year over year.
Yes, and the banks are deploying what they're calling autonomous finance.
Yeah.
Think of it like a personal CFO that lives in an app. It auto-reallocates your portfolio and manages risk without you having to lift a finger. If market volatility spikes, the AI reduces your position size instantly. A human freezes, the AI executes.
Okay, so we know the why. It's speed, it's scale, and it's discipline. Now let's get into the how. This is the part that usually confuses people, myself included sometimes. When we say an AI reads the market, it's not just looking at a price chart, is it? It's literally reading.
It is literally reading text. And that's where natural language processing, or NLP, and these large language models, LLMs, come into play. Financial documents are notoriously dense. A 10K filing could be 150, 200 pages of boilerplate legal text.
I've tried to read them. It's like reading specialized code that's been specifically designed to hide information in plain sight.
It is. It's obfuscation by design. And for a long, long time, computers were bad at understanding the nuance. They could count keywords, like how many times the word growth appeared,
Yeah.
but they couldn't understand the context. Now, we use a technique called RG, that's R-A-G, or Retrieval Augmented Generation.
Okay, let's unpack ARGI, because the word generation sounds like it's just making things up, which is the last thing you want in finance, but that's not what it's doing, right?
Right. Not at all. In finance, hallucination, where the AI just invents facts, is an absolute disaster. RAG is the solution to that problem. Imagine you're taking an open book test in school.
Okay, I'm visualizing high school chemistry, not my best subject.
A standard LLM, one without RA, tries to answer the test questions from memory. It might remember the answer, or it might misremember it. Aura, on the other hand, forces the AI to go to the textbook first. So if you ask it, what are the biggest risks for Apple this quarter? The AI doesn't just guess from its training data. It first retrieves the specific risk factors section from Apple's latest SEC filing. It reads that specific chunk of text, and then it summarizes only that text.
So it can actually cite its sources. It can point to the exact paragraph in the document and say, I found the answer right here. No guessing involved.
Exactly. And the models we have now are incredibly specialized. You have Bloomberg GPT, which is a 50 billion parameter model that was trained on 40 years of financial data. You have Finbert, which is a smaller model, but it's hyper-specialized just for financial sentiment. These models can do things that even the best human analysts struggle with, like detecting happy talk.
Happy talk, is that a technical term?
It actually is in the world of behavioral finance. It's when a CEO uses overly optimistic adjectives, complex grammar, or just generally fancy words to gloss over a decline in revenue. These models can flag that discrepancy. They see that while the tone of the language is happy, the numbers of the tables are sad. It's essentially a lie detector for corporate spin.
That is incredible. So it's analyzing the text. But what about the charts, the good old technical analysis, head and shoulders, cup and handle? Is AI actually looking at the squiggly lines on the screen?
It is, but it's not looking at them the way a human does. We're seeing the rise of machine learning and pattern recognition that could detect these deeply nonlinear relationships. And the big breakthrough here is the use of transformers.
Transformers. Okay, this is the same architecture that's behind things like ChatGPT, right? How in the world does that apply to a stock price?
Well, the magic of a transformer, the thing that makes it so powerful, is something called the attention mechanism. Imagine you're reading a really complex sentence. To understand the last word of that sentence, you often need to remember the first word. Your brain pays attention to the important parts. Transformers do this with market data.
So instead of looking at words, it's looking at price points or events.
Exactly. Traditional models, the old ones, looked at data sequentially, step by step, Monday, then Tuesday, then Wednesday. They had very short memories. A transformer can look at today's price action and instantly link it, or attend, to an acro shock like an interest rate hike from 3 months ago, while completely ignoring all the random noise in between. It sees the whole picture, the entire context all at once.
So they connect the dots across time, finding relationships that a human would just never spot.
They do. And we even have things called buy transformers now, which process the market data in both forward and reverse directions simultaneously. It's like reading the entire history of the stock market backwards and forwards at the same time to understand the deep geometry of how the price moves.
It's fascinating how these technologies have finally trickled down, because everything we just talked about, LLMs, buy transformers, that all sounds like institutional grade stuff. That sounds like something Goldman Sachs builds and keeps locked in a vault.
Yeah.
But the big story of 2026, the real paradigm shift, is that this is now the retail toolkit.
That is the game changer. We are seeing the true democratization of these powerful tools. And it has led to this really cool concept of the agentic squad.
This is what I wanted to get back to, the squad. So you don't just have one bot anymore, you actually have a team.
Right. And this is a key insight. The mistake people made back in 2023 and 2024 was trying to build one super bot that does everything. One piece of code that reads the news, watches the charts, manages the risk, and places the trades. That's just too complex, it's brittle, it breaks.
So you specialize, you build a team just like you would in a real company.
Exactly. You, the human trader, you act as the CEO, and you hire your digital employees. You have a researcher agent. Its only job is to scan news, social media, and earnings reports. You have a technician agent that does nothing but watch chart patterns across 1,000 stocks at once. Then you have a risk manager agent, and this is crucial. It does nothing but enforce your stop losses and your position sizing rules. And only then, at the very end of the chain, do you have an executor agent that actually places the trade.
It's like being the manager of your own personal hedge fund, but all your employees are just specialized pieces of code.
That's exactly it. And platforms like Agent Factory and even integrations with project management tools like Monday.com are allowing everyday users to build these custom teams without knowing how to code. You just drag and drop, assign the roles, and set the rules of communication between them.
So let's get specific. Let's talk about the tools that are available right now here in 2026. Who are the big players in this retail space? If a listener wants to download something today and start building their squad, what are they looking at?
There are quite a few, and they each serve a different niche, a different role in that squad. For the really active day traders, you probably start with Trade Ideas. They have this incredible engine called Holly AI.
Holly, I've heard of her. She's like the night shift worker who does all the prep before the market opens.
She is. Holly runs millions and millions of simulated trades overnight, every single night. She looks at everything happening in the global markets while we sleep. She analyzes the specific market conditions right now and then backtests 70 different strategies to see which ones would have worked in similar conditions historically. So by the time the market opens at 9:30 a.m., she presents you with a curated menu of maybe 5 to 10 high probability setups.
So you wake up, you grab your coffee, and Holly basically says, "Good morning. Given today's volatility and sector rotation, here are the 5 trades that historically work best in these specific conditions."
Exactly. It's pre-market validation. It narrows your focus from thousands of stocks down to a handful of actionable ideas. And Trade Ideas also has this thing called Stark Race, which is this 3D visual of market momentum. It helps you see where the big money is flowing instantly. Then you have a platform like Tickeron. They focus very heavily on transparency. They use what they call financial learning models, or FLMs.
Tickeron is interesting because they're really trying to solve that black box problem we talked about, right? I mean, personally, I hate following a signal if I have no idea why it's happening.
Yes, that's their core value proposition.
Yeah.
They have these things called micro-algorithmic explainers.
Mm.
So instead of just flashing a signal that says buy Apple, it tells you why. You'll say buying Apple because its RSI is oversold. NED, its trading volume, is 200% above the daily average. AMD, it just broke a key resistance level. It explains the logic. And that is absolutely crucial for building trust between the human user and the machine.
And what about for the people who want to build their own strategies from scratch, but, they can't code? I'm thinking of the visual learners out there.
That's where a tool like Composer comes in. It's a completely no-code platform. They call their strategies symphonies, which is a cool name. It's a visual editor. You literally drag and drop logic blocks onto a canvas. You can build a rule that says, if the consumer price index is less than 3%, then buy the SPY ETF. It's incredibly intuitive, and they have a community marketplace where you can see, test, and even swap strategies with other users.
I love that. It almost gamifies the process of strategy building. But isn't there a hidden risk there? If I just copy a popular strategy that worked great last year, does that mean it's going to work next year?
That is the single biggest risk in this entire field. It has a name, and it's called overfitting.
Okay, let's define that clearly for everyone. Overfitting.
Imagine you're studying for a big history test. But instead of actually learning the historical events and their context, you just get a copy of last year's test and you memorize the answers. Question 1 is A, question 2 is C, question 3 is B.
You'll get 100% on that practice quiz. You'll feel like a genius.
And you will completely fail the real exam because the professor wrote new questions. Overfitting is when an AI model memorizes the random noise and quirks of the historical data, rather than learning the underlying logic. So it looks absolutely amazing in a backtest. It made millions of dollars in the simulation, but the moment you turn it on in the live market, it fails completely because the future never looks exactly like the past.
It's like studying the answer key instead of studying the subject. So how do we stop that? How do I know if my shiny new squad is just overfit to the past?
You need rigorous out-of-sample simulation. This is the unsung hero of the whole AI revolution. Backtesting and auditing. We have platforms now like FX Replay that are doing some really cool things in this space.
FX Replay has that mentor AI, right? I've heard it's pretty blunt.
Yes. And it's supposed to be. It doesn't just track your trades, it audits them. It acts like a brutally honest coach. It might send you a report that says, hey, I noticed you consistently hesitate for 4 minutes before entering a winning trade, and that hesitation costs you an average of 15% of the potential profit. Or, your London session reversal trades fail 63% of the time. You should probably stop doing that.
That is brutal honesty, but the kind of honesty that saves you a lot of money.
It does. It forces you to confront your own data, your own weaknesses, and it allows for simulation mode, where you can take a strategy and test a dozen different variations of it 100 times in replay mode before you risk a single dollar of real capital.
And then you have things like Monte Carlo simulations. The name sounds like you're gambling Monte Carlo, but it's actually the exact opposite. It's advanced risk management.
It is the opposite of gambling. A Monte Carlo simulation stress tests a portfolio against thousands or even millions of potential future outcomes. It shuffles the historical data, it introduces random shocks, it simulates black swan events to see what happens in the absolute worst-case scenarios. It helps you find the probability of ruin for your strategy.
Probability of ruin.
Ah,
That is a terrifying term, but I guess I'd rather know what it is in the simulation than find out in my bank account.
absolutely. You want to break the strategy in the simulator so it doesn't break you in the live market.
Now, we can't talk about the new world of trading in 2026 without talking about the rules of the road, because something massive, truly game-changing, happened on the regulatory front. The pattern day trader rule, it's gone.
The death of the PDT rule. This is huge. For 25 years, since 2001, if you had less than $25,000 in your brokerage account, you were severely restricted. You couldn't day trade freely. You were limited to just 3 day trades in a rolling 5-day period.
Which always felt like it was punishing the small guy. The logic was, we are protecting you from yourself.
That was the stated intent. But the reality, the unintended consequence, was that it prevented people from using proper risk management. Imagine you're in a trade, you've got a small account, and the trade starts crashing against you. The right thing to do, the disciplined thing to do, is to sell immediately and take the small loss. But you think, oh no, I'm out of day trades. If I sell now, my account gets locked for 90 days.
So you hold,
Yeah.
you pray,
Yeah.
and you probably lose everything.
Exactly. It forced people to hold incredibly risky positions overnight, turning a small mistake into a catastrophic one. Its removal changes everything. It opens the floodgates. Smaller traders can now use these AI tools to scalp, taking tiny profits and tiny losses very quickly, without the fear of their account being locked out. It finally aligns the regulations with the reality of modern, fast-paced markets.
But with all this new power comes new risks. And we aren't just talking about the old risk of losing money on a bad stock pick. We are talking about new AI-specific risks. Besides overfitting, what should people be looking out for?
The first one that comes to mind is AI washing.
AI washing, is that like greenwashing for finance?
It's the exact same
Red flagged
concept. You have brokers and platforms that are rebranding old basic indicators as AI to hype up their products and charge more.
Right.
Just because it has a microchip or uses a simple moving average algorithm doesn't mean it's artificial intelligence. You have to be really careful and ask what you're actually buying. Is it generative? Is it learning and adapting? Or is it just a fancy calculator with a really good marketing budget?
And then there are the hallucinations. We talked about how our guy is supposed to fix this, but it's still a major risk if you're using the wrong tools.
It is a huge risk.
Yeah.
There was a horror story circulating a few months ago where a trader asked a general LLM, not a specialized financial one, just a basic chatbot for a stock price. It gave a very confidently precise figure, but it was off by $9.
$9. In trading, being off by 9 cents is bad. $9 is a complete catastrophe.
It's unacceptable. And that is why you need to use these specialized agents, not just a generic chatbot you ask about recipes. And then there's that happy talk bias we mentioned earlier. If the source data is biased, if all the CEO comments are overly optimistic, the AI might learn that bias too.
And the regulators like the SEC, they're watching all of this very closely, right?
They are. There's a new regulatory mandate that's gaining traction for explainable AI, or XAI.
Explainable AI. So does that mean the black box is now illegal?
In a sense, for regulated institutions, yes. You must be able to explain why the AI made the trade it made. You can't just throw your hands up and say the algorithm did it. Transparency is rapidly becoming a legal requirement, not just a feature.
Let's try to make this concrete. Let's look at some real-world scenarios. We've seen huge success with this stuff, and we've seen epic failure.
On the success side, look at the rise of smart portfolios, like the ones you see on platforms like Macro Venture. These portfolios can auto-hedge against macro shocks. When inflation data comes out hotter than expected, the AI automatically sells some tech stocks and buys some commodities to adjust the portfolio's exposure. It's preserving capital in a way that manual traders often fail to do because they just freeze up in the moment.
And the failures. Where does it go wrong?
The failures almost every single time come from relying on these black boxes without any human oversight, especially during black swan events. When something completely unprecedented happens, a geopolitical crisis no one saw coming, a new pandemic, the AI might not have any historical data to reference. It gets confused. If you were asleep at the wheel and just letting the bot run, it could dig a very deep hole very, very quickly.
So it seems like the consensus for 2026, the model that's actually working, is the hybrid model.
That is the winning formula. The best trader in 2026 isn't a machine, and it isn't a human. It is a human with a machine. The humans provide the context, the wisdom, the strategic oversight. We understand the why of what's happening in the world. The AI provides the speed, the scale, and the unwavering discipline to execute the plan.
It's a cyborg future, but for your stock portfolio.
Ideally, yes. That's a good way to think about it.
So bringing it all together now, we've gone from the data explosion all the way to the specialized tools, to the risks and regulations. If you're listening to this and you're intrigued, you want to get started, what is the actionable takeaway? Do I just download an executor bot, turn it on, and go to the beach?
Absolutely not. Please do not do that. That is the fastest way to go to zero. That is not investing.
Yeah.
It is a very expensive form of gambling.
So what is the first practical step?
You start small. You use the concept of an MVS, a minimum viable strategy.
MVS, I like that. It's manageable.
And you use AI to augment your research first. Don't start with execution. Let an AI like Genova or Holly summarize the earnings reports for you. Let a tool like TrendSpider automatically draw your trend lines and chart patterns. Get comfortable with the researcher and technician agents in your squad before you even think about handing over the keys to the executor agent.
Crawl, walk, then run.
Exactly. And only when you have months of simulated data showing that the AI is disciplined and effective do you let it run autonomously. And even then, you always keep a hard kill switch.
This has been an incredible deep dive. We've covered so much ground. But before we go, I want to leave our listeners with one last thought to chew on. We spent this whole time talking about how AI gives you an edge, but technology, by its nature, tends to diffuse. It gets cheaper and more accessible over time. So what happens when everyone has access to these super intelligent agents? If everyone is using Holly and Genova and ARG models on the same public data, where does the edge fit?
That is the multi-billion, maybe multi-trillion-dollar question, isn't it?
Does the market just become perfectly efficient with no edge left for anyone? Or does the AI start playing poker against other AI?
I think we are heading very quickly toward the latter. It gets weirder. If you have AI bluffing against AI, spotting micro patterns in order flow that humans can't even perceive, let alone comprehend, we might start to see volatility regimes that make no logical sense to the human eye. We're entering a poker game played at the speed of light, and we might just be the spectators watching the chips fly.
A poker game played at the speed of light. That is a wild and maybe a slightly terrifying thought to end on.
It certainly is. The future is going to be interesting.
Thank you for joining us on this deep dive into the world of AI trading in 2026. Build your squad, stay skeptical, and we will see you next time.
Happy trading.